The major averages back at record highs and adding to gains this morning. Let's bring in Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, thank you for being here. So we got trade talks this week. We've got a Fed meeting, and we have Mag 5 earnings, with the exception, obviously, of NVIDIA and Tesla. How do you think it all shakes out on this very busy week?
Well, good morning, Leslie. I think what it's shaking out is it's telling us that the positive vibes, the momentum is really what's ruling right now. I mean, one of the surest ways that to get this market to rally is imply that there's something good going on in trade. We saw it in the first Trump administration when sort of seemingly every morning I'd wake up and the futures would be a little higher, and the rumor would be that some trade talks were going well, even if there was no apparent trade talks actually occurring. So in this case, we're actually doing it, and you can see the market's positive response because the Asian trade talks seem to be going well, but meanwhile there was very quietly a 10% tariff on Canada, which is basically lost in the news flow. So it tells you the way the market is geared toward interpreting any trade news as good news.
Yeah, Goldman had a piece out, I believe, over the weekend focusing on the underperformance of the quality factor. It says that's in part due to a short squeeze, noting a basket of most shorted stocks has doubled since the market low in April and has rallied more than 30% since September. Would now be a good time, you think, to get back into quality, given just all the uncertainty that's out there?
Well, first of all, we've seen a lot of action in what I would call thematic stocks. I won't, put them in.
Just so diplomatic.
That's very yes. But number 2 most active stock on our platform last week was Beyond Meat, and number 5 and 6 were Rigetti and Oklo. So it tells you that there's a thematic play in question here. But actually, what's encouraging to me is the reaction that so-called quality stocks or old economy stocks had on earnings news. Coke reacted well. We saw Dr. Pepper reacting well today. So this is telling us that there is a little bit of latent demand for these things. I hate to say it because I sound like a stop clock a lot of times by saying, you never go wrong with high-quality stocks that pay a good dividend. And sometimes low vol is actually the way to go when you're in sort of a momentum-driven environment, sort of to zig when the others are zagging. But right now you could more or less throw a dartboard and things are working.
But to Leslie's point about the Goldman note, they argue that actually moving back to quality might not make sense because short interest is so high and they're counting on those guys to cover eventually.
Well, this is really the question. I mean, if you're shorter-term focus, I mean, honestly, momentum is the factor that rules, and that's really what's going on. If you're longer-term focus, I think you may want to consider whether we're getting a little bit of nosebleed at some of these levels and move into things that have not been priced as aggressively.
Yeah, obviously it's a big week for earnings. We've seen a third of the S&P 500 already report. The vast majority, I believe about 87%, have beat on the bottom, the bottom line, although estimates have come down ever since that April time period. How would you characterize what we've seen from earnings so far, and what does that bode for the remainder of the season?
I think what's interesting to me this earnings season is how well the stocks are doing when they're doing well. I know that's sort of circular, but they're being rewarded for good news, whereas typically in most earnings season you'd get clobbered if you missed, and you'd get a nice bump if you gained. In this case, it's actually almost two-sided, or maybe in some cases the market's willing to overlook some stuff. Let's say in the case of Tesla, where the numbers missed and the stock ended up higher on the day anyway. So we are starting to see a more charitable approach, shall we say. What's interesting to me is I'm looking at there's a number that I watch sometimes called VIX 9D, which is the VIX, except instead of looking at 30 days, it looks at 9 days. You've laid out a case for why these 9 days could be exceptionally volatile, and yet that number was, I think, below 14, which implies pretty much nobody's really looking for a lot of fireworks, either from think about Wednesday. You have the Fed, you have Microsoft, you have Meta, you have Google. Now, in theory, they could all sort of balance each other out, potentially, but in reality, there's a lot of potential volatility that could come, and we're actually getting it. A day like today, where we're up almost 1%, that's volatility. Volatility calculations are meant to be agnostic. They don't care if you're going up or down. Volatility for people, what we're seeing today is socially acceptable volatility. What we don't want to see is a move of this magnitude on the downside. That's when I get phone calls, what went wrong.